In a world where China is closing down again, Europe is heading into an inflation-led recession, Russia is in an economic depression, and U.S. Treasury bond values are crashing with negative returns from Fed tightening. Are U.S. equities now the only game in town? Hi, everyone. I'm Veronica Dudo, and welcome to Buy, Hold, Sell. Let's bring in the traders, Toby Smith and Todd Schoenberger. Todd, you say the markets are looking at rough times ahead, but Wall Street isn't listening as stocks continue to rise. What should investors expect going forward?
That's right, Veronica. I got to tell you, going forward, we can only suspect that this is the only game in town. You have higher interest rates that are going to be out there. You also have a U.S. economy that's likely going to end up turning into a recession. So therefore, we have to also think about the headwinds that are happening worldwide. But right now, everybody doesn't care. It's all stocks. That's the green light right now. And we can only suspect that that can't go on for any longer.
Toby?
Well, you know, Todd sometimes is wrong, but in this case, he's just vehemently wrong. I mean, there's a couple of things going on here. First off, yes, we are the only game in town. Our stock market is owned by companies and pensions all over the world. And from all over the world's standpoint, easy for me to say, what are they going to do? They're getting crushed in bonds. Remember, the old idea in investing was you had like 60% of your money in stocks and 40% in bonds. Mm-hmm. And when stocks went down, the bonds went up in value. Well, we're on a complete change to that. We've had stocks hit a bottom in this correction, and then with the Federal Reserve raising rates, the whole thing, the bonds are down 15, 18%. So it is the only game in town right now for the world. And we saw that with huge amounts of cash coming into ETFs and other mutual funds, over this week. So,
but
they're voting with their feet. And right now it's America.
How does it continue? How does this continue, though, going forward? You're going to have to suspect that eventually, because of inflation, you're going to have a hit on discretionary incomes. That will impact revenues for these companies, and therefore it's going to impact stocks. Remember what Larry Kudlow always said, the mother's milk of higher stocks is always going to be earnings. And if the companies don't have earnings going forward, you can only suspect that we have some rough times ahead.
Yeah, well, I'm not sure Larry's even alive anymore. But the issue here is that if you look at actual earnings. Now, we're going to be starting earnings season in the next couple of weeks.
Right.
And that's going to be the test, right? Because the first quarter earnings of the last quarter earnings of 2021 didn't have, a little war going on. But what we're seeing early and talking to CEOs is they are A, raising prices, B, some of the products, our supply chains are lightening up, but most importantly, everybody's got a job, Todd. Mm-hmm. We have 10 million jobs open for 4.9 million people available.
And one in three is making
that's
under
a strong
15
economy.
an hour. Yeah, 1 in 3 is making less than 15 an hour. That was the most recent information that came out of the Commerce Department. Look, here's the thing. You just don't have people that have the money that they once had maybe 6 or 9 or 12 months ago, mainly because you won't have a stimulus check every month that's being sent your way. That's one issue. Issue 2 is that you do have these higher gas prices, and we cannot suspect that those numbers are going to end up going down anytime soon. So that will have a hit on discretionary incomes. I think the telltale sign will be retail sales. Once you start seeing people that are not spending as much money, maybe not taking as many vacations this summer, if that's the case, that will have an impact on stocks. But we might not see it until the third or fourth quarter.
But we're sort of in a binary position here. If somebody thinks that we're going into recession, typically, as everybody knows, we get a bear market and our stock's down 20% because they're anticipating a recession, negative GDP growth. But there's no data that I can put together that we're getting to negative GDP growth. I absolutely agree with you, Todd, that we are slowing, from a 3% GDP, from a 7 to a 4 to a 3 to maybe a 2. But that's not that's not a recession. And again, the other side is, what are you going to buy? You're going to buy bonds and lose another 20%?
Nope.
So stocks are the only game in town, and United States of America, is the only game in town where you can buy highly liquid stocks with earnings going up, not being great. And you got to buy something. I don't know, Todd, you were a money manager. When I was a money manager, when I get in at 6:30 in the morning, I had to buy stuff. I couldn't sit in cash.
True.
So for people like me who run money that need to be in stocks, I think there's great opportunities, and we'll get into those, I'm sure, as we get along.
Yeah, and you mentioned earlier about the 60-40 split, the asset allocation. That's the number for investors. 60% of your portfolio in stocks, 40% in bonds. Realistically, though, going forward, because we have had such a run-up, those numbers obviously are going to be altered. Maybe it's now 70-30 or 80-20. Investors right now, especially buy, hold, sell, and watchers definitely want to take advantage of the higher prices and maybe lock in some of those gains and maybe go back more to a 50-50 split. But what do you think?
Well, here's how we're advising. We're in this changed world. And I think what we're forgetting is that, we had interest rates, we had inflation rates coming down for 32 years. We had interest rates coming down for 32 years in a row. We're in a new world. It wasn't just the pandemic. That sort of changed the world in many ways, obviously. But when Russia decided that they were going to attack Ukraine, now that changed the math on so many different issues. Energy prices are going to remain high, Todd. We're big investors in the energy space, and there's nowhere to go on that. So we're going to have a slowing economy. But what's happened is now I can buy a stock. I can buy an oil and gas pipeline. I can buy an oil and gas company that sells for 6 times its earnings, 6 PE, right? Versus buying, Zoom.com stock for 75 times its revenues. When these interest rates start climbing, when the Fed starts raising rates, you switch your strategy. And now you go to companies that make real money, are growing their earnings, and are relatively cheap, versus the rest of the market. Put your money there, Tado. You're going to do just fine.
All right, when we come back, we will be talking about whether investors can take advantage of sanctions against Russia.